Good afternoon, everyone. We'll start in just a few minutes. We are expecting just a few more people. Okay, I do expect a few more people, but in the interest of time, let's go ahead and get started. Welcome. Hi, I'm Ann Hendry with the Nonprofit Association in the Midlands, and we're excited here to be able to have a conversation, learn more about the Consolidated Appropriations Act that was passed last December. I want to welcome and thank our speakers today, our friends from Seim Johnson. We have Megan Koziol, who is a tax manager, and then Jerry O'Doherty, who is a partner at Seim Johnson. And in full transparency, he is a rock star member of the NAM Board of Directors. We're very fortunate to have him help us out. So today we're really going to learn from the folks from Seim about the Paycheck Protection Programs, loans, if it's your first time or your second time trying to access funds, and two new programs, the Employee Retention Credit and the Shuttered Venue Operators, or what I like to call Save Our Stages. I do want to let people know that this is being recorded today and we will share it with folks. But as most things these days, it is being recorded on February 11th at 12:03 p.m. Things may have changed by the time you actually listen to it. We also have Hannah Young from NAM is here monitoring the chat box. So feel free to put your questions in the chat box or message Hannah directly for those, and we'll try to get to as many as we can. With that, I would also encourage people to introduce yourselves in the chat. And with that, I'm going to turn it over to Megan and Jerry.
All right, great. Thank you, Ann. Really appreciate that. And obviously, I owe you a coffee or two for that great introduction. So I do appreciate that. We do have a lot of information to get to you, to share with you over an hour period. So with that, we'll just get started and do the best we can to hopefully have you walk away with some information that can help you and your organization. Real quick, there's the bio on myself. Let's bottom line it for you. I have 27 years of experience in public accounting. I serve over 50 nonprofits on an annual basis. And then I am a NAM board member as well as serving on the finance and then the retirement plan committee. So Megan?
I am Megan Koziol, manager at Seim Johnson. I have been with the firm for about 9.5 years, and I'm personally responsible for about 150 990s every year that go out. I'm a board member of Inclusive Communities, have been for 5 years, and I've been the treasurer there for the last 3 years.
So perfect. And so as Ann had already talked about, there are the 4 main topics that we want to go over with you today. And so we'll share those as you can see on the agenda. But before we get started, I always have to talk about that disclaimer that we have and Ann alluded to a little bit. So I'm going to read it here as always advised by our attorneys. This presentation is intended for those who's on today's webinar. The data is to be used for informational purposes and may not include all the necessary information to meet your specific needs. It may contain information that's confidential, privileged, or unsuitable for overly sensitive persons with low self-esteem, no sense of humor, or irrational political beliefs. At no point in time during or after this presentation are you to perform any sort of physical harm to any person or property, including that annoying neighbor that has not shoveled his or her sidewalk for weeks now. No animals were harmed in the creation of this presentation. Those of you with that overwhelming fear of the unknown will be gratified to learn that there is no hidden message if I were to read this disclaimer backwards. Taking this disclaimer seriously, besides the first 2 sentences, in any way, shape, or form is not advised anyway. So, all right, let's get started, Megan. So
Okay.
the first time as far as PPP borrowers, what we're trying to do with this presentation is we're trying to take the CARES Act, which is some components of it, which lead into ultimately what Ann referred to on the Consolidated Appropriations Act, that had 300 pages. The Treasury Act, or sorry, the Treasury then issued at least 24 interim final rules with over 100 pages. The SBA then issued frequently asked questions, 77 in total, for over 25 pages. And then with this new act that had 500 pages plus 200 pages of IFRs, so we're talking over 1,100 pages. So we're trying to take 1,100 pages and put into an hour presentation. So we're going to do the best we can, and hopefully actually you can walk away with some good information. So let's talk first-time borrowers. Right now, with the act, they put out $284.5 billion for the additional funding for both the first, if you hadn't received a PPP money at any point in time, or your second draw. The deadline is March 31st. But one of the things I really am cautioning my clients is their patience does come into play. And the reason why has to do then dealing with the employee retention credit. And once we get to that point, I'll explain further as to why that is. When the first PPP round came out, there was this mad rush. A mad rush because it looked like it was a first come, first serve. And if you didn't get your money, sorry, too bad. Well, now it's a situation where, at least as of the 10th of February, which is yesterday, they had about 100 billion of the 284 billion that's been used. Everything I am hearing from the AICPA, which is one of the organizations I belong to, is they're indicating they have no reason to believe that the funds will run out. So we just want to caution you, once again, this is different this time around versus the first time. The other item I want to bring up is this concept of self-assessment of need. When you do apply for the funds, you are going to have to certify that the current economic uncertainty makes this loan request necessary to support ongoing operations. A lot of times we will hear from clients that have a concern like, well, I don't know, do I need it enough or not? I don't know what's going on. The biggest thing I want you to walk away is that the intent of this program was to support small business. And when I say small business, that includes nonprofit, of course, as well. One of the things I want you to realize, or I'm not telling you something you don't know, when we talk about, you see in the news, currently in a pandemic, and then now they're talking about second strain, and we don't know what that's going to do. So it's really hard for me to believe that there isn't some kind of economic uncertainty that's taking place. Now, there are exceptions to that rule. There are, for instance, from what I understand, as from a restaurant standpoint, like the wing organizations that all they have is takeouts, they are doing extremely well. But so there could be some situations where that does not come into play. The one thing I really do want to make sure you do is document your situation. And the reason why you'd want to document that is on off chance you were audited, because all the talk is on this next stimulus that government's going to be putting out, that they're going to put some funds aside for auditing. If you ever were selected for to be audited, you'd want to make sure you have the support that indicates why you met that self-assessment for need. Next slide, please. And by the way, so thank you ahead of time to Megan for driving this presentation. So she does a great job as always. So the next thing is, so if you decide, I think I want to look into this, something I want to do, we want to talk about eligibility. As you can see here, if you have 500 or less employees, you are eligible. So if for some reason you're a large organization that's attending today, beyond that, unfortunately, you'd be outside that limit. There are a few exceptions. There's a few exceptions to virtually everything we're going to talk about today, but I do want to let you know there are a few exceptions. Any business, so as you can see, we bolded there is 501c nonprofit organizations, including churches. And then the last item I wanted to stress is one thing that's new is the 501c6 organizations, as long as they have 300 or fewer employees. So for instance, an example of that would be your Chamber of Commerce. All right, so next page. Ineligible borrowers. So if your organization closed permanently, you can't go for it. And basically what they are saying is the whole intent is they still want people getting money from a payroll standpoint. So if you've closed, you obviously cannot pay your people anymore. If you were not in operation on February 15th, 2020, what they're getting at is if you made the decision to open up after the pandemic effectively has started and is rolling, then it's kind of like, you made the choice. You obviously made a business decision that it was in your best interest to be working during this pandemic time. Entities receiving the Shuttered venue operator grant, and Megan will talk about that a little bit later here. Your publicly traded businesses. And then I'm always curious about, or I find it fascinating, the politics behind all these different bills and laws and legislation that gets passed. And they specifically, if you're affiliated with China, that you're not going to get that. I'm not putting an opinion whether it's good, bad, or indifferent. It's just that I've always find it interesting when you mention one, but not all the other. So anyway, that's my little side note. So, next page, please. So now that you decided you're eligible and it works for you, then the question is, well, how much can you get as an organization? What are you eligible for? And so you go through a calculation for the amount of the loan. And that is, you take it 2.5 times the average monthly payroll costs. So one of the things we want to make sure we added on the slide, it can be based on calendar 2019, calendar 2020, or the 12-month period prior to your application. So for instance, if you had not applied yet, and let's say you wait till March 1st, and you may wait till March 1st because we're going to talk about employee retention credit in a second, you could use February and January, and then the 10 months prior as far as your 12-month period, if that made the most sense. We do encourage our clients, make sure you look at both situations. And the reason why that's important, you don't get a second chance at this. Once you fill out your application, ask for the funds that you're looking for that period that you select, that's the most you can get. Because what you would not want a situation where if you would have used a different period that you could have used when you applied, that would have given you more money, but you didn't go through the calculation to figure out which was most beneficial, it's too late. Once you've done it, you can't go back to get it. Also, for your first-time people, it's up to $10 million you can receive. I want to caution, if anybody's on this call that does have a number of employees and it looks like you're going to reach that threshold, the way it's working out with the SBA right now is if there's a $35,000 per person average that the organization is going to receive, it's getting caught up in the system. So there's a hesitation. The SBA is aware of it. They're working on those types of things, but I just want you to be aware, if that situation applies to you, that it might be a slight delay. As far as your average monthly payroll costs, if you are making more than $100,000, it gets limited, meaning the most benefit you can get is up to $100,000 for your people, for any particular person as you're going through that calculation. So for instance, if someone made $150,000, the most, and when you're figuring out the average monthly payroll, would be only the $100,000. And what does payroll include? Includes a number of different things, but the things that you'd most typically see would be wages, group health. If you're in the restaurant industry, it'd be tips. But anyway, those are the main items related to payroll. All right, so now we just talked about your first-time PPP borrowers, Paycheck Protection Program. Now what we're going to do is talk about your second draw. So those people who participated the first round, things are going, got them through this, and now we have the question is, can I get some more funds to help me with my operations? Same thing. This is open through March 31st, 2021. It's still part of that 284.5 billion. This is not two separate components, but it's still available part of that same appropriated monies from the government. Eligible entities. One of the things I really want to stress on this. So you received your first draw, and the key is you have to spend it on eligible expenses, or you will spend it on eligible expenses before receiving your second draw loan. I have to stress this, and because I kid you not, we've heard the stories, none of my clients, at least that I'm aware of, fortunately, that some some people are spending money on things that they shouldn't be. So for instance, I heard of a situation where someone went out and bought a boat. That's not what this is intended for. This is intended for your eligible expenses, and we'll have a little discussion about some of those and what those mean. Also, what's new about this one is no more than 300 employees, which is down from the 500. And then you have this concept of more of a need, what they're trying to stress here. And that is, do you have a 25% reduction in gross receipts? So like most things, okay, so what does that mean? But before we get to what that means, we're going to talk about the amount of the loan. The amount of loan is essentially the same as it, from a calculation standpoint, as that first-time borrower. One slight difference, if you're in a different industry, once again, restaurants, they have a little bit slight different calculation, but once again, for nonprofits, it's 2.5. And the difference here, instead of up to $10 million, it's up to $2 million. So next page. As far as the reduction in gross receipts, so you have to have a 25% decline in your gross receipts in any quarter in 2020 compared to the same quarter in 2019. So once again, any quarter. The reason why that makes a difference is when we get to the ERC, there's a different calculation that's going to take place. And the way you have to prove that is you have to provide some kind of documentation. But quite frankly, they're quite liberal in terms of what you can provide, and it's not difficult. First thing is on your quarterly financial statement information, doesn't have to be audited, doesn't have to be reviewed, doesn't have to be compiled, meaning you don't need us as a CPA firm to help you through this process. You can go into your, I would expect that most people use QuickBooks, go into your QuickBooks file, look at the quarter, any quarter in 2020, compare that to the same one in 2019 to see if you've had that 25% decline in revenue or not. Also, if you don't have your financial statements in QuickBooks or some accounting software, you could go and look at your quarterly or monthly bank statements and look at gross receipts and compare those from quarter to quarter. And the last thing is, if you had to, you could always look at your annual IRS income tax filings. I think that's going to be a lot more challenging because the timing of when you would have that done or to be able to look at that, it may be more difficult. So quite frankly, I'm expecting most people will do first or second through this process. So we talked about gross receipts. Well, what's included, what's not included? As you might expect, your typical nonprofit, you're going to any kind of gifts, contributions, grants, membership dues, if that's the case. If you're selling or receipts from your business activities, proceeds from the sale of assets. So if you had a car for the organization, you sold that. And then investment income, interest, dividends, rents, and then royalties. What's not included are your PPP funds. So you receive the first round, it's not going to be held against you. So that's good. Your idle funds. So many organizations had received that $10,000 grant. And one great thing is when they did change this new act, it used to be that you were going to have to pay that back, but they did get that fixed. That's a grant. You do not have to pay that back, and it's not being used against you. Also, if you have investments, unrealized gains, that's not going to be included in your gross receipts. So that's all positive things. And then what happens is we get a bunch of questions like, okay, that's great. Now you tell me what it is or what isn't, but I've got these other things that are going on. What does that mean? And that gets into the maybe category. So one of the things that we've heard is, we have all these different kinds of funds. Okay, what does that mean for us? We are waiting on clarification. So the AICPA is more than aware that there is these other funds. So from Department of Health and Human Services, as an example, you may have received some special grant or funds. Omaha Community Foundation through Douglas County, I know has been providing funds. So there's a lot of questions out there. We wish we had those answers. We expect to get those answers soon. So I am on it's basically every week, every 2 weeks, depending on when they have these town hall meetings with the AICPA, and they provide us this hour meeting. And then what I do is I send out an email. By the way, if anybody were to want to be on this email that provides these updates, I'd be more than happy. You just have to make sure you provide me your email address or provide it to Ann, and then she can get that to me, and then I'll include you. And when I talk to one of the presenters, it's someone that's actually out of North Carolina, she says they are working hard to make sure that between the Treasury and the SBA, that they provide clarification, which would mean those should not count against you. I mean, they should not be included in your gross receipts. So the good news is there is a strong body of lobbyists that are working on your behalf. And as soon as we know that information, I'll be sharing that. We think if it should be included as taxable income, it's probably safe to assume it's going to be in gross receipts. Once again, looking for some clarification. And the one that maybe drives me the craziest one is on this net capital gains and losses. So when you actually sell your investments, if you had them, it's very clear for the for-profits that you don't include those. It's completely ambiguous.
Not mentioned.
Say again, Megan?
Said it's not mentioned at all.
It's not mentioned at all. They went silent on us. And so what we think that it's not going to be included, but we just want to let you know that's another item out there that they are aware of, they're following up on, and hopefully we have some information to provide for you pretty quickly. All right, so now we get to this concept of, I'm gonna check my time, I think we're doing okay so far. So for the second draw Paycheck Protection Program loan, we have on the cover period. So when the first PPP came out, it was 8 weeks. That's all you had. You had to spend your money for payroll and these other costs within 8 weeks. Then they came out and said, oh, no, you can choose. You do 8 weeks or 24 weeks. And what's really nice is they came out and provide a lot more flexibility. You can do it anytime between the 8 and 24 weeks. And this does make a difference if you're eligible for the ERC. And I'll talk about that when we get to that, but it does make a difference. The other part is, once again, that certification, you still have to do the same certification like you do with the first one. And then on the certification, the first draw, that you would use it all for eligible expenses. Why that's important? Because when you actually sign that, there's a comment on there that talks about jail time as well as fines if you were to certify and that wasn't the case. I don't know about you, but I don't look good in orange. So once again, just want to make sure you're aware that you're going to have to do that.
And one thing on the certification for the first draw loan, it's just that the money had to have been used for the eligible expenses. The loan doesn't have to be forgiven in order to qualify for the second draw. There's some banks out there that are asking for that, but it isn't a requirement that your first loan be forgiven in order to qualify for the second draw.
Yeah, great point. All right, so when you get to the part where you're forgiveness, so you've been blessed that you either receive the first or second draw, or receive both. And so now the question is, okay, what do you guys do from a qualification standpoint? The biggest item I want you to walk away with, at least 60% of your PPP loan. So once again, we're going for the assumption you want to have 100% of it forgiven. At least 60%. All of it can go payroll, but at least 60% has to be associated with payroll costs. If you're eligible for the employee retention credit, you want it to be not $1 more if you can help it. Meaning if you've got other eligible expenses, you want to have 40% of those to be used up and only 60% of payroll. And once again, I'll talk about that in a second. So if we go to the next slide. So of the different costs that are so we talked about the payroll costs up there, but the other non-payroll costs would be if you had mortgage interest, for example, rent or leases, those costs. Utilities would be an item. And by the way, utilities, there's a broad understanding, and some of it depends on your lender, what they'll allow you to use. It could be, if you're thinking about cable, you're talking about OPPD, MUD, you're talking about potentially trash, if you have a trash service. Those all could potentially be considered as utilities. And then there's these other items that were recently added as far as covered operation expenditures. If you use business software like QuickBooks, that'd be an item. Covered property damage costs. So if you were unfortunately in a situation where, because of the riots that took place in 2020 and some damage that took place and you had to repair that and it wasn't reimbursed by your insurance company, that would be included. Covered supplier costs. We actually need more guidance on this one, but it looks like it might include something like a cost of goods sold. And then on covered worker protection expenditures, It's everything that's taking place in any workplace, it seems like, that you go to. If you think about the sneeze guards, if you do a filtration process, let's say you add that to help in the fight against this pandemic. So those are different kind of costs that they're talking about. And that, once again, that's a 40%. You can't have more than 40% of those costs. But for payroll, you can have 100% of the costs. We just are recommending if you can get by with 60, because assuming you can participate with employee retention credit, it's in your best interest. Okay, next page. So I'm just going to, from a general standpoint, just want to point out that as far as your reduction in employees, and what they basically want you to do is they're giving you money for payroll. They don't want you to reduce your payroll, the number of people or the amount that they're being paid. So where the limits go is if you have a reduction of 25% or more, as far as in salaries and wages, you may have less forgiven of your loan. Also, if there's a decrease in your full-time equivalents, you could potentially have a reduction in your loan that's being forgiven. There are all these different, I think I enjoy looking at the nuances of the Pythagorean theorem more than I do the calculations that they're looking for on these FTE calculations, because there's a number of different ways they're looking at it. In certain periods, you look at from one compared to another, and did you have a reduction? Oh, and by the way, even if you had that reduction, you still have this period of time at the end in which you can make it up. And so you'd still have this safe harbor, or you wouldn't have a reduction in your loan forgiveness. There's a lot of complicated components in here, but we just want to make sure you're aware. If generally speaking, you keep the same number of people, you're not going to have any worries or concerns. Just want to point that out. All right. I've now talked about the parts of the PPP, and I've mentioned this employee retention credit a few different times. And now I'm going to talk about it and explain to you why this matters and how there's some interplay that's going to take place between both of those. So first of all, who's eligible? Anybody, any size, nonprofits, and that's the organizations we're talking to today. If you're engaged in a trade or business in 2020, so I'm expecting or anticipating most people on this call are, then the question is, from your eligibility standpoint, do you meet one of two tests? The first one is the government order test. The second one is the gross receipts test. So that government order test is the business operations were fully or partially suspended due to the government order due to COVID-19. So think about this from a standpoint, your restaurant that was all of a sudden, you can no longer do normal operations, you can only do takeout only. Then the second one, as far as this gross receipts one, is that the business has more than 50% decline in gross receipts in a calendar quarter in 2020 compared to that same quarter in 2019, and each successive quarter in 2020 until they have more than 80% gross receipts in the same quarter in 2019. That's a lot. And then the question is, okay, that you talked about the Pythagorean theorem, and like, oh, isn't the same thing? Yes, same thing. It's crazy, but we're going to make things easier for you because we are actually going to provide some examples to explain that one. But before we do that, I'm going to give some more information on the gross, government order test. I switched my pages too much. So this is an order from the mayor, local officials, local health department, that you had to partially close operations of the business. I have to stress that. It's the business that had to be closed down. And here's my example. So think of a car dealership, and that, let's say the car dealership itself was not ordered to close, but the customers were under a stay-at-home order. So think in terms of California. Does this qualify? The answer is no, it doesn't, because a car dealership, the business, wasn't required to close. Flip side, kind of gave this one away already, but the restaurant, they had to close the in-room dining, takeout or delivery were still open, so there's still something going on. Did that qualify? The answer is yes, because the government had ordered the business to have a partial suspension of operations. And then if you're able to continue business remotely, so think telework, there's no suspension. So for example, we're blessed in our industry, and I know the lawyers as well, is because of the technology that's available, our industries were able to still continue moving forward without I can't say without interruption because there's plenty of that, but they basically said if you're in a telework situation, this is not going to apply for you. I'll give a quick example that I don't know the answer to, but I'm sure we'll be looking into it. Think of a private school that had that period of time where they closed down, and so there was that telelearning that was taking place. But yet some parts of their activity were suspended, completely closed down. Think of the activities, think of sports that took place. So there's going to be, the reason why I'm bringing that up to you, I just want you to think in terms of how all your operations and were certain components forced to close. And so you may be eligible to take advantage of this credit. Now, if we go to the gross receipts, next page. So from a calculation standpoint, think of gross receipts, sales, net returns, allowance, investment income, the different components there. It's same typical ones: contributions, gifts, grants, membership dues. It does not include, so if you collect sales tax and you remit that to the taxing authority, that's not included. And this is silent regarding realized gains. So just want to let you know there's still more guidance we're hoping to get. So hopefully we'll get that relatively soon. I promised it, so I'm going to deliver. What is an example of how does this calculation work? So once again, you have to have more than 50% decline in gross receipts in 2020 compared to the same quarter in 2019, and then each successive quarter in 2020 until you get the more than 80% calculation. So that first quarter, 90% doesn't qualify. That next quarter, you get to the 40%, boom. Now you're into the gross receipts calculation. Quarter that follows 86%, so you rose above the 80% threshold, but it allows you to take advantage of that next quarter. It's until you get to the following quarter, that fourth quarter, that all of a sudden it's not included. So in this particular situation, you're going to be able to look at, from a credit standpoint, quarters 2 and quarter 3 when you're calculating your potential credit that you're going to receive. We'll provide another example. This one, as you can see here, you got 90%, once again, don't take advantage for the first quarter, and then you're at 40%, and then again 48%, both are under that 80% threshold. And then all of a sudden you bump up that fourth quarter, but since that's the bump up quarter, you get to include that as well. So in this particular situation, you're gonna have 3 quarters to be able to take advantage of that you met it, the criteria, assuming all the other criteria were met, to take advantage of the employee retention credit. Go to the next page. So items that include qualified wages include our gross wages that are subject to Social Security, and then some applicable healthcare benefits. So for instance, high deductible healthcare plans, FSAs, HRAs, but not HSAs. Also, this excludes amounts used to obtain PPP loan forgiveness. So this is where I was talking about the interplay. And that is, if you can use 60% to get the full forgiveness, that would mean essentially you'd have 40% of those payroll costs that if you're eligible for the employee retention credit, those could then be used for the credit purposes. So we really want you to, as you go through that forgiveness process and filling out the forms, if you have those other costs up to 40%, we want to fully maximize that for you. Because once again, if you qualify on the government test or the gross receipts test, you have an ability to get some additional credit money for your organization. That last item is as far as amounts paid to related parties. That I don't foresee that happening because it has to do with ownership greater than 50%. That's really kind of not applicable for the most part on nonprofits. So now that we talked about this credit, well, how much are we talking? And what the credit is 50% of qualified wages, but the maximum you can get per employee is $10,000. So what that effectively means is the most you could get is $5,000 per employee. So depending on the size of the organization, this can be a fairly sizable amount. But this is the reason why, once again, so if you're able to take advantage of PPP and you have this other program now with ERC, we want to make sure you're taking advantage for your organization. One last item we want to kind of talk about as far as number of employees. So if you're average 100 or fewer, you can look at all the wages for your employees. There's no limitation. It's only if you have more than 100 full-time employees, as far as on average, when you look at 2019, it's only on those wages to employees not performing certain services. So think about your furloughed employees. That's really what that's getting at for that. So we talked about 2020 ERC. Now what we're going to mention here is the ERC for 2021. This is where it becomes a much bigger ticket item. So a couple things. One, this particular thing got extended to July 1st, 2021. I do want to let you know there's talk right now going on with this next stimulus that this thing is going to get extended even further. So that's good news. The credit increased from, instead of 50%, it's up to 70% for 2021 wages. So that makes a difference, quite a big difference. Why it makes quite a big difference is because this next part, instead of at the maximum wage of $10,000 per employee per year, it's now $10,000 per quarter per employee. Much bigger dollar amount that we're potentially talking here. And then as far as that gross receipts test, so there's a lot of difficulty that, maybe you had a nice comeback, but wasn't as good as you hoped. So instead of a 50% reduction, it's a 20% reduction. So that's going to bring a lot more organizations in and getting this credit in 2021. And the way you're going to do that is you're going to compare your 2021 quarter to the same 2019 quarter. Okay, so think of first quarter 2021 to the first quarter 2019. Also, this next one, which is a little bit more confusing, is it's talking about comparing the preceding calendar quarter to the same quarter in 2019. So if we're talking about quarter 21, so instead of using that, you're like, well, I'd actually be better off if I use the fourth quarter of 2020, which is the preceding quarter for quarter 1, 2021, and compare that to the fourth quarter 2019. If that gets you to the 20% reduction, then all of a sudden you're in. So we just want to let you know it's getting better. It's getting easier to qualify for this. So that's why we're talking to you about, if in a 2021 situation, if you don't apply for that PPP until say March 1st, say March 15th, and you qualify, all of a sudden you're going to have wages from January 1st till that point in time that will qualify. And then if they were to extend it, you potentially will be able to take advantage of some of the wages after you got the forgiveness for the second round of your PPP. You potentially could take advantage of getting the credit for there. I probably lost you on that last part, but just want to let you know there's interplay between the two of them, and we just would want to make sure you're maximizing that. Enough of me. There's enough of me at the beginning anyway. But anyway, so we'll turn over to Megan. Megan?
Yeah, so I am going to cover the Shuttered Venue Operator Grant, which was newly written in on the Consolidated Appropriations Act. They set aside $15 billion for what they're calling shuttered venues. And of that 15 billion, actually 2 billion was reserved specifically for operators that had less than 50 full-time employees. So there is some specific money set aside for the smaller businesses. To be eligible for this grant, as Anne was calling it earlier, it's the Save Our Stages. So it's the live venue operators, your theater producers, your theater operators, talent representatives. The SBA actually does a pretty good job on their FAQs for this, about going into more detail of who's considered eligible for this grant. Some of the things with like the live venue operators, there's some specifics about you have to have fixed seating. So if you're running kind of a multi-purpose room that can, like a wedding venue that you can move things around, or you could use it for something else, that wouldn't qualify. It's only your operators that have fixed seating that would be included in that category. Or there's some specifics about ticket sales where, a restaurant that has live music that plays while they're doing their work wouldn't qualify because they didn't sell tickets for that. So there is some clarification on who's eligible for this, but if you are an eligible entity, there are a few other things to keep in mind with it. You would have had to have been in operation as of February 29th, 2020. And the other thing that's also a very big consideration here, and another reason to wait on this second round of PPP loans, is if you received a PPP loan after December 27th of 2020, you are not eligible to apply for this grant. So you could have received a PPP loan in the first round, that's perfectly okay, but it's after this date if you received the loan, then you're not qualified. So there's also some questions about if you've applied for a PPP loan already, you do have an opportunity to rescind your application or have it rejected, and you would still be able to qualify. It's if that PPP loan gets accepted, that would put you out of being eligible. So the amount that is covered in this grant is, if you are in operation for all of 2019, it's up to 45% of your gross earned revenue, which is again another calculation that some money qualifies and others don't. They always have to make it difficult. Up to $10 million on this one. If you started after January 1 of 2019, but were in business as of that date in February of 2020, then you would calculate the amount of your grant that's eligible is the average monthly gross revenue for each full month that you were in operation times 6. So it's about a half a year of your 2019 if you were in business for most of the year. Another piece. So the PPP funding disqualifies you from being qualified to apply, but other CARES Act funding does not disqualify you. So if you were getting some DHHS funds, if you got an EIDL grant, any of those aren't going to disqualify you from this grant. It's just the second round PPP funding that would not allow you to apply. So the gross earned revenue calculation to figure out what that would be for your venue is any money that's received from the sale of goods or services. So it doesn't include things like your donations, your scholarships, any of that investment interest dividends, rent, none of that's included. It's just the money that is received from the sale of goods or services. But that also includes, if you had fundraising event revenue, the portion that's considered not deductible to the attendee, so that gross revenue portion of the fundraising event receipts, that does get included. So it's that piece of it would be included in that gross earned revenue amount. There's also another kind of qualification that no more than 10% of it can come from federal sources. So if that's just another one they wrote in there to kind of specify, but disaster assistance isn't included in that. So money received from the sale of goods and services and your fundraising event gross revenue. What you can use the grant funds for is basically any of your regular, ordinary business expenses. So things like payroll, rent, utilities, any sort of worker protection expenditures, state and local taxes, any of those things would qualify as eligible expenses to use the grant money for. Now, what you can't use it for are making investments. So purchasing real estate, any other sort of investing or loans, and debt payments for loans that are originated after February 15th, 2020. So if you had a loan that was before that you had taken out before February 15th of 2020, you can use the money to make the payments on that. But any sort of loan after February 15th, you cannot use these grant funds to make those payments. Now, the SBA hasn't actually opened this program yet. They keep kind of saying that they're working diligently on making it available, but it has not opened yet. When it does open, they have set kind of a calendar of who is going to be eligible to receive these funds, kind of, and what their priority order is. So for the first 14 days that this program is opened, only operators that had 90% or greater revenue loss between April 2020 and December 2020 are going to be accepted. The second round runs for the 14 days after the first round, and that would be open for anyone with 70% or greater revenue loss. And then 28 days after the first and second priority is open for anybody that had 25% or greater revenue loss. And this one, instead of being from that April 2020 to December 2020 limit, the third with the 25% or greater revenue loss, it's kind of that quarterly comparison similar to the PPP reduction. So it's 1 quarter of 2020 compared to the same quarter of 2019. And then after all 3 of these rounds would be passed, any eligible entity is eligible to apply for supplemental funding if any of the money is still available. So from there, if you had received a first, second, or third round award and you suffered 70% or greater revenue loss in your most recent calendar quarter, then you can apply again for another grant that would cover up to that 45% of your gross earned revenue. So there is kind of an opportunity here if you're an eligible entity that you definitely want to figure out if this is going to be more, get you more money than a possible second round PPP loan because you are not able to have both. So it's definitely something to keep in mind and kind of try and figure out before applying for that second round loan, which is why we keep hinting at waiting on that one for a little bit longer. So that was all we had today, I think.
So it looks like there's some questions. So between the Q&A and the chat, let's see if we can address these. So I'll look at the first one. Christine, you had in there as far as board member share guidance from the IRS implies that you could only take the ERC if your request for forgiveness on your first PPP was denied. Has that been clarified at all? I am not aware, I'll say from the standpoint of any issues. What I think what the board member is referring to is when this originally came out, if you received PPP funds, period, you were excluded from being able to participate with the ERC. Then with this new act that was passed at the end of December, they clarified it and said, nope, you are now eligible and can participate. So that's a situation that now it's good. It's allowing more people to participate. Even if you were denied, let's just say, so let's use the example. When I think of denial at this point in time, well, first of all, if you couldn't get in, then it's a non-issue. Then all of your payroll, assuming you meet the other criteria, you'd be able to apply. If you're thinking denial from standpoint of it didn't get forgiven for whatever reason, you decided you did not want to have it forgiven because you felt like you're better off getting ERC credit, you're going to actually get more credit than using the payroll for the PPP, you could go that route as well. So hopefully that answered that question.
And I think if it was forgiven, it's not eligible for the ERC. So if that's kind of where Jerry had mentioned the 60% payroll ruling is if you can still have payroll above the amount that you have on your PPP application. So if you can qualify for full forgiveness, using only 60% of that payroll, that other 40% of the payroll, I believe, is still eligible for the ERC,
Correct.
which is why we're kind of stressing to try and include some of those other costs in the forgiveness. So anything that was on that forgiveness application as payroll wouldn't qualify.
The other question in the Q&A section is directed at you, Megan. And it says, are all volunteer, no paid staff organizations that are still 501c3 orgs, a theater company, eligible for the shuttered venue to help cover other non-payroll expenses?
I believe the answer is yes. It's not specifically payroll. It doesn't have a qualification that, 60% of it has to be for payroll. It's just for ordinary and other business expenses. So if, you're still paying rent and utilities and you have other business expenses, I believe the grant funds would still be eligible to be used for that. I don't think payroll is a requirement for this grant.
There was another question, is should Nebraska stabilization grant be included when determining the 25% reduction in gross receipts? That's the one that we're still waiting on answer. Go ahead.
I was just going to say that's a maybe.
Yeah, we're hoping to get more clarification on that one. Then Dawn had one as far as says, our organization has left a number of positions open after employees voluntarily resigned. Does the choice to leave positions open negatively impact either the ability to request a second loan and or loan forgiveness?
No. As one of the exceptions that is on the forgiveness application is if the employee voluntarily resigned, then it doesn't go against your 25% reduction in FTEs. So that is one of the exceptions that is in the instructions and in the application. So
good question. So during the Q&A, and can we clarify what to do if you do qualify for ERC, more than 20% gross receipts reduction 2021? Do we just work with the payroll provider, or do we just end up not paying as much money in payroll taxes in the future for the amount we qualify for based on the previous qualifying quarter's amount, or do we receive reimbursement funds from the government? So there's a couple things there. One is there is this form that you could file ahead of time if it appears like you're going to be qualifying for it, where you do reduce the amount of payroll that's going in your quarterly filing. So you can go that route. The other route you go to get the money back is you can amend the returns. So here's one that's a little bit different or unique. Let's just say you qualify, we're going to talk 2020 for a second, because it's a little bit different than 2021. But for 2020, if you received a PPP loan, you could simply amend your fourth quarter 941 payroll report to get the funds back. If you did not receive PPP funds and you qualify for the 2020 ERC, then what you're going to have to do in order to get that money back is you have to amend each of those quarter returns, payroll returns, as we understand the rules. Coming back to the 2021, essentially probably the easiest way it's going to be is when you complete each quarter, you would reduce your pay, and then if you have a negative, call it that amount, which you would, then you would get a refund at that point in time. But there is an advanced funding, and then as far as who mechanically is helping you out with that, I'm anticipating all the payroll providers will be up to speed on the way this is working, because this is such a big ticket item. I haven't yet seen that take place, but they changed the rules relatively recently for those who are PPP. Could they take advantage of ERC? So I'm not surprised I haven't seen it. Megan, I don't know if you've seen any of the.
I have, the only ones I have seen have been, we've amended their previously filed 941s.
Okay.
To reduce the amounts.
And those were the main questions. I don't know if there's any others or if I missed any.
Yeah, I'm not seeing any more, but feel free to drop one in the Q&A. We still have a few minutes left. And just a reminder, we did record this. We will send out this recording to the NAM CEO listserv, so you can refer back to this wisdom time and again as we navigate what's next in the world of federal funding. And as we learn more on the Consolidated Appropriations Act or any other nonprofit related stimulus legislation on the state or federal level, the NAM team is working hard to keep you informed. And I'm assuming the recording will include the slides. So you betcha, I'm seeing that in there. And lots of kudos and thank yous for our panelists. So let's give Megan and Jerry a round of applause. If you think of any questions after this, feel free to email either Hannah or myself, and we'll get Megan and Jerry the questions and get you the answers that you need. So stay warm, bundle up, and hope to see you all soon. Thank you.
Thanks, everybody. Have a great one.